Hello and welcome to Fridays with Vistage. I am your moderator, Lori Allen. These reminders, we'll be posting the link for the PDF version of the slides momentarily, and the archive will be sent to you by midweek next week. Later, we'll be telling you about a great webinar next Friday that you'll want to register for. But on to today's topic. Our guest is Dennis Najjar. He's the co-founder of accountingdepartment.com and has worked in public accounting since 1982. After graduating from Rutgers University, Dennis joined Coopers & Lybrand. In 1986, Dennis started the public accounting firm Dennis N. Najjar CPA. His practice has an emphasis on tax planning and preparation for corporations, partnerships, and individuals. Throughout his career, though, Dennis has worked exclusively with small, medium, and startup businesses, giving him the experience to oversee the accountingdepartment.com team, help Vistage clients grow with strategic business planning. Dennis, the floor is yours.
Thank you very much, Lori. Well, welcome, and thank you for joining me today. It's a beautiful day down here in sunny Florida, and so hopefully you've got some nice weather wherever you might be. But if you can get some attention focused on this topic, I want to try to demystify or deconstruct the P&L and help you to better be able to review that with your accounting personnel and make sure that they are giving you good information that you can rely on. Okay, we've got two objectives for today. To enable you, the owners, the founders, the C-level executives, to be able to challenge the information you are receiving on your P&L. You should not just accept it in blind faith. Granted, you are not the accounting people, but you should be prepared. I want to prepare you. This webinar will enable you to go back and challenge what you might have been looking at for months or years in the P&Ls that you've been given. And the second objective I want to address today is to help you uncover issues and have a clear understanding of what to look for. I'm not going to make you an expert, but if you can challenge the status quo, you're going to find out whether or not the bookkeeper you have or the accountant you have or the controller you have is really doing their job. You'll be able to tell once you start to ask some of these questions and, you know, how they look at you in the eye, how they shuffle the papers around. I think that'll give you a good indication of, how confident they are about the information that they've been funneling to you. So let's get started and begin to deconstruct the P&Ls to better prepare you. Let's start off with some fairly basics. And I say basics, but, I don't want to kind of rush by it and not take a few minutes and explain the importance. A lot of this is about importance and understanding. If you understand something, it'll make you a better executive, a better business owner, and you'll feel more confident in the questions you're going to ask. Now, this is a very simplistic slide I'm about to show you, but it will show its relevance as we move through the rest of the presentation. So every P&L needs to start with revenues. Of course, if you're a startup business, you won't have any of those. But for the most part, all established businesses are going to start their P&L with their revenue. One thing we don't necessarily take for granted in a lot of the financial reports that I look at is that there's actually a cost of goods sold or a cost of services section in that P&L. Because the difference between the two of those is your gross profit. The gross profit is, in my opinion, and in my conversations with business owners, my bias, if you will, is the most important number. I don't care about revenues. I don't care about net income. I only care about gross profit as the most important number to focus in on, to target in on. Because gross profit is what is going to determine your survivability. Do you price your products or services at an appropriate value to generate a sufficient gross profit to enable you to do what? Cover your general and administrative expenses. Cover your sales and marketing expenses. After you deduct all of that, you come up with your operating income. So as we work down the P&L, these are the major stepping points that you want to be able to see. Now, I would say for the most part, you should see these fairly easily on your own P&Ls. And then once you get past that, you get to that infamous thing called EBITDA, earnings before interest, taxes, and depreciation, and then finally you end up with your net income. So of all these numbers, the first place I like to go in a conversation is gross profit. I always say to a business owner, hey, tell me how you price your services, or tell me how you mark up your product. And then I'll immediately turn and do some quick calculations on their P&L, and presto, oops, the number they just told me isn't quite what I came up with. And why is that? There's a disconnect somewhere. Often it's bad information they're working on, or the financial report, the P&L in this case, is not properly tracking the cost of goods or the cost of services to present the correct gross profit. So let's talk for a few minutes about some of the high-level things, some of the things that are going to jump out at you, that are going to give you an indication of whether or not the P&L that you're looking at is properly laid out, properly formatted. Now, I'm going to put this right on the table right here and now. Most businesses, when they start out, have what I would call a homegrown chart of accounts. You start a file. We are a 100% QuickBooks-based company. All of our clients are on QuickBooks. There's lots of different options with regard to it, but we have determined that that's the product that fits all of the client situations that we get engaged in. That being said, it's very easy to start a QuickBooks file, for any of you who have done that. And you know, when you're going through the process, one of the things that pops up is to start a chart of accounts. And they'll ask you a few questions, and before you know it, presto, there's a chart of accounts. That usually doesn't mean much to anybody, and so at that point, they just proceed on. But as time goes on, what happens is you start to think, well, maybe I want to add an account for this or an account for that. And before you know it, you've created this homegrown P&L that, as we'll see later on, doesn't always give you a good, solid presentation of your financial information, and will be, a very staticky, very cluttered type of presentation. So the first thing I want to point out about this sample P&L, this one that I'm labeling incorrect, is that it doesn't have numbering. Now, I know immediately, when I rehearsed this, I said to myself, the first words that are going to come out of my mouth after I say there's no numbering is I'm going to say, you're all thinking it's an accountant's thing, that they want to number the chart of accounts. Well, to the most part, it is something that accountants do, but I want you to understand why we do that. We do that for a couple of reasons. The most important reason is so that we can put the chart of accounts in a properly formatted order. If you don't have numbers, there's only one way your accounting program is going to present it back to you. It's alphabetical. And alphabetical doesn't give you a good flow to your income. It doesn't, or your expenses, excuse me. It doesn't allow you to group things or put them in the right order. I mean, amortization would be at the top, even though that would be something that really should be down at the bottom. So using numbers is a tool to allow you to make the presentation the way you want it to be. Now, in this sample chart of accounts that we're looking at, one of the things that we will notice right away is that there are no cost of goods sold or cost of services. It's blank. And again, as I stated in my introductory remarks, this is common. Businesses don't generally understand this. So go back, look at your chart of accounts, ask yourself two questions, or look at your P&L. Ask yourself two questions. Do I have accounts in there? And are all the accounts that should be there included? So let me help define for you what belongs in your cost of goods sold or your cost of services. I'm going to give you the definition of it. And the items that you want to include in cost of goods sold or cost of services are those expenses that go into generating the revenue. Those expenses that go into generating the revenue. So if you sell something, obviously buying that product and reselling it, that cost goes into cost of goods sold. If you manufacture something, the raw materials eventually will make their way there, the packaging, the finished goods, et cetera, makes your way there. If you're in a service business, your largest component for a service business will be labor. the people who are delivering. If you're a consultant, if you're an architect, those salaries, the portion of them at least that belong to the delivery of service, need to be part of your cost of goods, cost of services, in order to properly calculate your gross profit. So the first thing we see here that's missing or incorrect on this P&L is that there's no numbering. The second thing we see is that there's no cost of goods sold, no chart of accounts. There's a couple of other finesse things here that are creating confusion when you look at this sort of a financial report. The first one is that there is the ability to use headers with sub-accounts. The purpose of a header is to aggregate several other accounts that are related, but for which you want to keep track of and visualize separately. So, for example, if we go over here and we circle this section here, we'll see there's an account called professional, and then there's accounting, legal, other. And so that's all well and good. You can have an account called other. There's nothing wrong with that. But there's also something called professional other. And if you look at that, it's got $41,000 in it of a total of $57,000 in that whole expense area. Well, what does that mean? Well, what that means is that there's $41,000 worth of expenses on this P&L that should be somewhere in accounting, legal, or other. But in the process of classifying them, they did not select the sub-account. They just decided to post it to the header account. Hence, the information becomes worthless, becomes useless, because you can't draw any conclusions about the legal fees that you're paying or the accounting fees that you might be paying, because you've got some $41,000 that hasn't been put to a specific account. So that's an improper use of a header account. Unnecessary sub-accounts are situations where you set up a header account, like this one right here, or this one over here, but you only have one sub-account. So you've created this hierarchy of account and header account and sub-accounts, yet there's only one sub-account. So it creates this extra layer of information. All of these little nitpicky things, if you will, are driving a P&L that is not very useful. That's not very easy to decipher or to gather information out of, because you're getting all these extra pieces of information that aren't really useful. So we've got no numbering. We're lacking a cost of goods sold section or a cost of services if that's the kind of business you're in. We're using the header account to post to when we should be using the sub-accounts that we decided were important in a particular area. And then we set up one sub-account under a header, which defeats the purpose of having the header account. Let's take a look at what a revised chart of account would look like. And the visual appealingness, now, of course, I'm a little biased because I created this one, and so I made it look pretty, well, at least to me it looks pretty. Hopefully to some of you it looks pretty. But what do we immediately see? It's a lot easier on your eyes. So everything is numbered. And when you number things, you also have the ability to create the order they go in. So if I had numbered them, app income would have been higher than, commissions would have been second, and then books and so forth and so on. Here, the way I constructed the numbering sequence was to place priority on the revenue that I wanted to track. So my biggest stream of revenue is on-site seminar attendees. So I want that to be my first GL account, and so forth and so on. So by numbering everything, I can then put them in the order I want to appear, and it's meaningful. As I look down that, I'm not skirting between the different line items trying to pull out the information. It's very easy to see the progression from the highest number down to the lowest number in terms of what makes up the revenue. In terms of our cost of services or cost of goods sold, we've got a fully fulfilled one now. It's got a whole bunch of different accounts in there, and you can see there's also a header account. The instructor cost is a fairly big size number, and so I wanted to break it out between the fees I pay the instructors and maybe some of the travel and meals and lodging, because that's a big part of what they do when they do this instructing. So I want to see the costs that are being incurred. So when you decide what has to go into cost of goods sold, for example, or cost of services, you're also thinking about what high-level relevant information should I look for, do I want to see to help me understand what's going on in any aspect of the business. So now we have this gross profit percentage, $455,000 of gross profit over the income of $1.274 million, roughly 20%. And now when I'm having that conversation with the business owner, and he says to me, yeah, I work on a 48% gross profit, and I say, well, your numbers don't quite show that anymore. The proof is in the pudding. It's right there. You can also see here that the accounts have been set up to break, there's nothing here. I did find one mistake, by the way, which I will point out. There is one other that got left around here that shouldn't have been. It should have been put into one of these sub-accounts. But as you can see, all of the sub-accounts now, all of that $57,000 is spread out amongst all the different accounts. And you will not find in here any headers with a singular account underneath it. So a very nice and easy and flowing type of report. It starts out with the revenue, brings in your cost of goods sold, gross profit. You get into all your G&A expenses, so forth and so on, and then you end up with your other income and your other expenses, which is your EBITDA that we talked about at the very beginning. So when someone says to you, hey, what's your EBITDA, you would be able to pull that number right out. It wouldn't take you all kinds of calculations. You don't need to export anything to Excel and, delete numbers or add numbers back. If you properly format your P&L, you can spit that number out lickety-split. All right. Now, let's step back now, and let's talk about how much detail. How much detail do you really want to have? How do you make that decision? Well, the first example here is not enough. It's not granular enough. Just to say everything is revenue or everything is in cost of goods sold doesn't give the reader enough information. At the other extreme, we've got too much. And we've got all these sub-accounts, which is the way to go. We've got the fees and the travel and the meals. But then we decided to turn it around and take it one step further and break it down by the instructor and list out as a sub-account for each cost of goods sold, a sub-account for each instructor. Now, obviously, I just presented 3 here, but if you had 333, if this was what you were trying to capture in your P&L, it would be a very, very long P&L. You would lose the effectiveness of it. There's other ways to capture this kind of information. So this one is a little too granular in terms of its top-side presentation. So what's the right mix? The right mix is a summary. As we saw on the corrected P&L, we had the 5 or so revenue accounts in ascending order or descending order. We had 1, 2, 3, 4 key cost of goods sold accounts with one where we broke it into a couple of sub-accounts. So high level. The P&L is intended to be high level, not to be extremely granular. So the right measure would be something closer to the one on the far right here. We talked about the incorrect use of header and sub-accounts, so this just kind of drives that point home. We've seen these numbers before, but I wanted to make the picture a little bit bigger so you could see it and understand it again. Get these numbers. If you see your P&L and you see that there's something called other, if you happen to be a lot of programs do the same thing. I'm speaking specifically, of course, of QuickBooks right now. But if you get a P&L and you see other strewn around throughout it, that's a good indication that you're not looking at a complete picture. You don't know what your workers' comp was. You don't know what your property and liability insurance cost you either, because you've got some $15,000 that hasn't been put to the correct accounts. And so if we use the proper accounts, we eliminate that. You can see now we've got an auto insurance that's about $5,000 more, and a property and liability is about $10,000 more. So now you have good useful information that you can be understanding your costs with. Another very common area that I find is not reflected correctly in P&Ls is payroll. The most common presentation I see is recording payroll as net. You know, if you're using a payroll service, they give you two figures, right? What do they give you? Net pay and gross taxes. The gross taxes represents the employee withholdings and the employer expenses. And many P&Ls just take those two numbers and plant them on the P&L as payroll and payroll tax expense. The problem with that is a couple of problems with it. First of all, your wages are understated. This is not your true wages. This is your net payroll. This does not give you a good indication of what your gross payroll is as a percentage of any other number on your P&L, if it's in cost of services or if it's an operating expense. The other problem is your payroll taxes are grossly overstated. You know, this we're looking at about a 30% tax rate based on this presentation, because that $42,000 encompasses both the employee's withholdings as well as the employer's expense. So very common. It's especially very common when you're using a payroll service, because that's the way those numbers come in or appear as a draft in your bank account. The second most common presentation that I see is just, what the hey, let's just throw it all into one account and just call it payroll wages. And there's nothing there. There's nothing. Wages are totally overstated. No taxes are reported anywhere. No tax expenses reported anywhere. In both recorded as net and recorded without taxes, neither one of those will match your 941s, your W-2s. Your accountant might be spending extra time trying to figure it all out, to make sure that the amounts that you're deducting for payroll are matching, W-2s, for example. So another commonly incorrect way to report payroll. Of course, the best practice, the one that we use for all of our clients, and I'm sure many other accountants do as well, is to properly reflect. Payroll taxes should be broken out. The payroll is recorded as gross, and then the payroll tax expenses are often broken out by type. There's 2 federal taxes every employer pays, and there's often at least one state tax that an employer will pay. And again, these should be reconciled to the various quarterly and year-end payroll reports, and that process is facilitated by correctly recording gross and the expense. And it also gives you the accurate picture that you need when you're looking at your financial reports. All right. Now, in QuickBooks, they have something called Claus. In other programs, they might call it departmental tracking or profit centers, or in our example here, these are the different speakers that we have employed who go around the country and do presentations. And so I refer to this, whether you call it a department report or a profit center or a speaker, it doesn't really matter what you call it. I like to refer to these as a two-dimensional P&L. Why is it two-dimensional? Well, your traditional P&L is what I call one-dimensional. It's one column with a series of rows. And so you get this intersect point, right? A row, a number, a row, a number, and then tally it all up, and you end up with the bottom line being your net income, your net loss. A profit and loss by class or department or profit center or speaker, what that's doing is it's giving you a two-dimensional. It still has the rows, but it's not just a total column. It's giving you the department or the profit center, the location, whatever your dimension is that you want to measure. A very, very valuable tool if it's used correctly. Now, to the untrained eye, I don't know if any of you have this, you should be pulling out that P&L by class. I know many of you use QuickBooks. Pulling out that P&L by class. And if you happen to see something called Unclassified, then you are looking at a half-baked profit and loss report. That two-dimensional report, I'll be very frank, is worthless to you. Because what Unclassified means is that there are, in this case, revenue and cost of goods sold transactions that have not been assigned to Dave, Tim, or Warren. They've just been recorded to the proper GL account, seminars, app income, instructor fees, what have you, but they didn't assign them to one of the three speakers. So now when we look at their reports, we can't really draw any meaningful conclusion about the profitability of each of them separately, which is the whole purpose to this two-dimensional report, because we have this $128,000 worth of income, $84,000 worth of expenses, $200,000+ worth of income that didn't get pushed to each of them or somebody. It belongs somewhere. If you're going to do this kind of an analysis, if you're looking for a two-dimension, if you want to be able to dive into your financials from a different vantage point, it's got to be complete. So when you go back, and if any of you are using this report, all you got to do is just look for the column called Unclassified, and you'll know right away whether or not the people who have been giving you these reports have been giving you good information or not. All right, let's take a look at what it should look like. All right, what it should look like is right there, all zeros, goose eggs. Now, you don't normally see Unclassified. I embedded it to drive the point home. So you shouldn't, if you don't see a column called Unclassified, I don't want you to be under the impression that there's still something wrong. The normal reporting would be to not have the column. So we inserted it just to make it look, for presentation purposes. You can see now what happened. Well, all of that revenue and expenses slid someplace else, but lo and behold, there's actually a whole other department or profit center that wasn't even being reported on. That just by making someone accountable to the fact that we wanted to see this reporting by department or by profit center, understand or realize that, well, there's this piece of our business, things that get sold through our web store, that we have to create a whole other class for. So you'll ultimately have multiple classes. If you're going to use this, it's very simple. Everything belongs somewhere. Now, another two-dimensional report that many of our clients ask us for, and that is extremely useful, is a P&L by job costing. Everybody knows that term, and it's just another way to slice the information. Before we looked at the entire P&L. First set of slides was at the entire P&L, top to bottom. Second set of slides is about that second dimension, profit and loss by class, aka department, profit center, etc. This third slice, which is also a two-dimensional slice, is looking at it by venue. So these happen to be the venues. So we have a Chicago show, we have a New York show, we have a San Francisco show. And those are three separate events, and we're tracking the event-wide activities here to analyze the outcome of each one of those. And of course, now we have our web store because we determined that to be a class, so we've got to track that as well. So looks good, right? We've got a P&L, and it's giving me information and showing me revenue and expenses, showing me what my gross profit is. Looks like the San Fran location did the best out of the three. So I'm just going to do more San Francisco shows next year, is I guess the conclusion I would reach. But Virginia, there is a Santa Claus, and I just recently read that in the newspaper. In what month are we in? November? November. Might have been October. Read that in October. It was kind of humorous because my kids grew up watching that show. But let's dig a little bit deeper and see if we really are capturing everything, or what questions do you need to ask. So, got that same slide brought over from the previous. We've got the Chicago, the New York, San Fran, the web store, and I've highlighted the last column, the totals column. I'm going to compare these job reports, which is again, it's a slice. It's a second dimension of that information. It's the same information. but it's not being completely reported again. As you can see, if you compare the yellow items line by line, pretty much with 3 exceptions, there's something missing, right? There's something missing. So we've got on-site attendee revenue for our 3 venues of $261,000. However, our P&L shows we've actually collected $359,000. There's $100,000 unaccounted for in our job reports, and that just goes right down to the bottom. Just taking it right to the bottom line, you can see our job reports on the left say our events generated a gross profit of $54,000, but our company-wide P&L says that we generated $166,000. It's a big variance between those two. Now, here's a little bit different than with the P&L by class. So the P&L by class, if you're a QuickBooks user, does give you that column called Unclassified. It just puts it right in front of your face, and it says, hey, guy, you forgot to put me someplace, so I'm just going to hang out here in this column called Unclassified, and maybe you'll figure out that you want to put me someplace later on. The job P&L doesn't do that. You've got to look at it a different way. You've got to do what I actually did just here. You actually have to say to your bookkeeper or your accountant, let's compare our P&L to our job P&L. You don't have to go down every line. I mean, you can pick a couple of key numbers and you'll know right away. What I usually focus in on is, first of all, I go right to the gross profit. If those two numbers, if that $53,000 obviously is not matching that $166, I know I got to work backwards. And then from there, I'll typically drill into the 2 groupings. I'll first look at revenue. Is revenue a problem? Or I'll look in cost of goods sold, and I'll say, is the cost of goods sold the problem? Or are both of them a problem? And so you can begin to narrow it down. But what you're doing is you're creating accountability. Here you are asking to track job costing information, being given a job P&L, yet you don't know without asking these questions if what you're looking at, what you're making decisions on, is complete and accurate. So after we do some cleanup, this is what our P&L would look like by job, and we'll throw next to it our company-wide P&L, and now you can see up and down every line item matches. So that's the accountability. A lot of what you should be picking up and making notes on here is how to create accountability, what questions to ask to determine whether or not that person really even understands what they're doing or has already addressed some of these things. So when the questions get answered, you don't have any differences. Everything matches up. The next topic I want to talk about is a little esoteric, and to most clients, it does seem to be a topic they don't fully enjoy talking about. But I think it's important. I wanted to spend a few minutes and go over the 3 methods of accounting. First, at the base level, to talk about the differences, to kind of boil it down into simplistic terminology, if you will. But then, more importantly, to talk about the pros and cons of each one. What are you getting and what are you giving up with the method you select? Now, there's no one size fits all, and different businesses should be choosing different methods. Which one you choose, which one you follow, is going to depend on your business. But I do want to clarify one misconception. And that misconception is the method you use for your financial reporting does not need to be the same as the method you use to file your tax return. Many consulting businesses, many businesses with labor as their main component, no product, there's no inventory involved. Those companies will probably be reporting their taxes on a cash basis. There's a couple of exceptions to that. We're not a tax planning session here, so I'm not going to get into all the combinations. But suffice to say, most service-oriented businesses will be filing their tax return on the cash method of accounting. However, the cash method of accounting, while it's good for taxes because it prevents you from paying tax on receivables, and most service businesses will have more in receivables than they will in payables, that does them no justice in financial reporting. It gives them no insight into their financial operations. So let's walk through the three methods of accounting and see if I could demystify, that and encourage more of you to go back and start asking for or requesting that your financial reports be presented on the higher level of accounting that we're going to talk about right now. So the base level, everyone knows, cash method. I've talked about it a little bit. Just to give the talking points, revenue is reported when it's deposited. Expenses are deducted when you pay them. You're not focused on receivables. You're not focused on payables. It's basically an in and out type of accounting, very centric to a bank account. So a lot of different businesses could use that. Cash basis businesses would be a lot of retail operations, so they don't really have receivables. Maybe the payables are not a big deal either. But it's the simplest method, and it is used by a lot of businesses, especially for tax reporting. I'd say the more common method for financial reporting, not very common for tax reporting, but the most common method for financial reporting is what's called the modified cash method of accounting. And what that method of accounting does is report the revenue when you make the sale. Report the expense when the bill comes in. You end up tracking AR, you end up tracking AP, but there's one subtle difference that it doesn't do. What it doesn't do is consider when the sale is completed or the goods are received. So I'm going to give you a quick example to kind of give you the visual of what this would look like. So we're going to say that last week, October 30th, you made a sale, big order comes in, you generate the invoice, and this is a service business, so you generate the invoice and you send it out to the customer for $10,000. So on the modified cash method of accounting, that goes right into receivables and right to your P&L on October 30th. Monday the 2nd, you say to your team, we're going to deliver this service, let's go out and do the work. And so in early November, you go ahead and do the work and you pay the payroll. Maybe you have a subcontractor or two involved. You get their bills in, you process payroll, and all of those expenses show up in the P&L in November. So in this case, modified, you're doing what the method states. You are reporting the revenue when you generated the sales invoice, and you're reporting the expenses when you receive the bill, or in this case, paid the payroll, albeit they happen in 2 separate months. So there's not a good matching that goes on. There's not a good correlation between the two. And that's what brings in the highest level, the most refined method referred to or called accrual method of accounting, the accrual method. And it takes that modified method and expands upon it. And so in my example, that $10,000 invoice that got generated because that's when the customer said, sure, I'll buy your service, you could have still dated it October the 30th. But what you would have done under the accrual method is you would have said, whoa, let's not put it on our P&L yet because we haven't done the work. Let's put that on our P&L in November. Well, you want to still get the invoice out. So there's an accounting thingamajigger you do, and you basically put it on the balance sheet. It's called deferred revenue. Same thing happens with prepaid expenses. If the reverse happened, if you went out and had to pay a couple of consultants in October for a project that was going to wind down in November, and so you pay them, but the invoicing didn't actually happen until November, then you take those expenses and you put them on your balance sheet as a prepaid expense. Sometimes you buy something, most common is insurance. So, depending on the premium, it could be $15,000, $20,000, $50,000, and maybe you get a quarterly installment plan. Well, you don't want your P&L being hit 4 times a year with these large amounts of insurance that are expected to cover a 3-month period. So you put that on the balance sheet every time you go to make the payment, and then you spread it out or you amortize it over whatever number of months it's intended to cover. All of this is doing something very important. It's smoothing out the income and expenses. It's matching it. When you go to look at a P&L, if you have these gyrations in numbers, especially on the expense side, you're going to struggle to understand what that means for your business. And the most likely reason for those ups and downs in line items is because you're incurring expenses that benefit multiple periods. And so by utilizing this concept of accrual accounting and the principle of matching, the balance sheet becomes the holding bin for these expenses or revenue that are not ready to be reported on your P&L. So let's take a look at an example of that to kind of give you the visual on how that's going to work. So we have this cash method of recording. So we went to the far extreme. There's no AR or AP being tracked here. And so again, we've got our 3-month period. We're looking at July, August, and September. We've got our P&L revenue accounts, our cost of goods sold accounts. And based on when these things occurred, based on when money came in, based on when payments were made, we show a 3-month P&L. July made a profit of $265,000. August made a profit of $28,000, and September lost $79,000. Now, if you're a business owner and you're looking at this, you got to be scratching your head. Otherwise, you're not really understanding what these numbers are telling you. Because what this tells me is, my God, we're going to be multi-billionaires because we just made $265,000 in 1 month. And the next month rolls along, and you get that little slap in the face. You get that sense of reality. Oh, I guess we're back to reality. We're only going to make about $30,000. Then you wake up in the 3rd month, and you go, oh, my Lord, what happened? We just lost $80,000 this month. What are we doing wrong? Well, what's doing wrong here is how you're reporting all these numbers. This whole theme we've talked about is, about this, these seminars and being, selling tickets and paying presenters and all that. That's been the theme of all the examples, that have gone on. And so I'll drive home what these numbers are telling you. The $251,000 up here, these are pre-sales. The actual seminar happens in August. That's why you see nothing in September. Nobody's going to my show without paying, either paying in advance or paying at the door. So the bulk of my money is coming in the month before the actual show happens. Now, down below in the expenses, I got most of my, maybe about a third of my instructors got paid in the month the show actually happened, but the bulk of my instructor fees didn't actually get paid until the month after. So you've got things happening before the actual event, things happening after the actual event, and honestly, they're just a bunch of numbers. You can't, I would have a hard time looking at this and telling you anything about your business. So I can only imagine how you would feel or not be able to feel looking at this and saying, okay, what do I do with this information? Well, what you need to do with it is get on the accrual method of reporting. So let's take a look at what that would look like if things were done correctly. Again, the numbers have been highlighted to give you that insight into what's changed. So as you can see, there's no on-site revenues in the month of July. That $251,000, as it came in, would have been put on the balance sheet in a deferred revenue account. That's a liability. It's a lot of accounting stuff. Don't worry about that part. You just know to go back and say, hey, I want my reports on the accrual method of accounting, and I want you to be able to include any sort of prepaid expenses. I want to make sure we accrue expenses that we haven't gotten, and we've got to think about accruing our payroll and all these other accounting adjustments that any qualified person is going to be able to, tell you what needs to be done. So we've got the revenues now all matched in the right month. There's some other things, the book sales, if you will. There was some of that happened in advance, but again, that's all tied into the show, so that's been shifted back as well. When we go down to the expenses, this is where we have the accrued expenses. What's an accrued expense? An accrued expense are expenses that relate to a month, in this case the month of August, but haven't been paid or will not be paid until a later month, as opposed to a prepaid, which is something that's paid in advance. So that $105,000 is now moved back to it's recorded on the balance sheet as a liability called accrued expenses. And when it's recorded in August, it brings the 47 up to the 152. So, and the rest of the numbers follow the same pattern. The travel was paid in advance. I mean, you can't book your travel after you had the show, right? So you got $7,600 worth of travel that got paid out in July on the cash method. Well, that's been put on the balance sheet, tracked as a prepaid expense, and then moved back to the P&L in August when the show occurred. And the same theory will happen with lodging and so forth. So what's the bottom line? Well, we go to the bottom line, and we can see that a normal month, just some books and materials that we would sell in the normal course of our web store, people buying our app, maybe some commissions that we make, the book material costs. Well, our real month of July was about $8,000. Same thing. We look on the month of September. We take all those numbers into consideration, and we've got a normal month of about $9,000. And then our show, our big event this quarter or this year, whatever, you fill in the blank, showed that we made $200,000. Now that's meaningful, as opposed to $265,000 followed by $28,000 followed by a $80,000 loss. That's what accrual reporting will do for you and your ability to understand your P&L. Understand your P&L. That's it, gang. That's how you demystify your P&L. Take this information, compare it to your own, kind of huddle in your office with the PowerPoint slide, get your, call over your bookkeeper and ask for the P&L and ask for a balance sheet and ask for a P&L by class if you're using that function, job reports, ask them for everything. And then just follow along. And then sit down with them and have a conversation and ask them to, help you understand why these numbers look the way they do. And you can fill in the blank with the questions that you might come up with. All right. Well, that should do it. And I think we have a few questions.
Oh, Dennis, we have quite a few questions. But first, I want to thank you for explaining this so well. First question is, how often should the budget be reviewed and changed when the gross revenue just isn't hitting the goal?
All right. Well, you're not going to, if you sit down and you do a budget, you have to have a realistic expectation of achieving your numbers. It shouldn't just be numbers that you make up with a hope that you're going to hit them. And when you don't, you get to change them. So there has to be some substance behind them. And if you go on a period of 3 or 6 months and you feel there's a need to revise, you need to revise with some sort of reason behind that. So you obviously don't want to do this too frequently, a revision. I mean, that defeats the whole purpose because then you're basically making your actual back into your budget. And if you go too long, then you may run into a financial problem because you've probably also made expenditure commitments based on revenue projections or budgeted revenue. So it is a bit of an art, as much more than a science from a frequency point of view. But I would say you should be evaluating it at a minimum every 3 months and then making some modifications if needed.
Good. Our next question is a two-part question. Is there a good basis to go on when deciding what financial info to share with different members of the team? Does anyone below the C-suite need to know any of that information?
Okay. This is going to somewhat be a function of the ownership of that organization. If it's a privately held company, they will normally keep the financial information somewhat private, not generally disclose it to everyone in the organization. There's usually C-level people, even in smaller privately held companies, that will be aware of and be involved in the financial reporting. As an organization changes from a privately owned to maybe a funded organization, there's a whole different mindset because there's knowledge that there's funding coming from the outside, there's accountability from that, and everyone is made aware of the progression in the objective of that company. So you tend to share more information as you change your mode of operation from being a privately held company to one that is a funded company.
We had a question come in about QuickBooks. Does QuickBooks offer systems to record manufacturing cost accounting, such as direct versus indirect costs and cost of goods sold expenses?
Okay. All right. Over the last couple of years, Intuit has reborn itself, or has gone for a rebirth. That rebirth has played itself out in this way. For many years, they tried to be everything to everybody, and they kept adding things to the program that were generic in nature to appeal to the broadest range of customers, because they have millions of customers. But they had, I'm going to say, an awakening about 3 years ago, 2.5 years ago now, in which they changed their direction. Their direction now is that they view themselves as the nucleus for the accounting operation, the ledger, if you will. And they have wildly opened up their integration with third-party apps. So while I think that QuickBooks would offer a modest or a simple level of inventory type of functionality, what you really want to be looking for are third-party apps now that can provide that specific set of features that you need for your individual businesses. And there are numerous. There's well over 1,000 now, because they've put a lot of emphasis in opening up that code to allow third parties. So you're going to find in all different industries what's now referred to as third-party apps that will integrate with QuickBooks and allow you to do specialized things like inventory. So that's the direction I would recommend you look in.
Are any recommendations or anything to stay away from on those?
No, I would respond this way. There are two types. You're going to find that when you go and you look at the QuickBooks App Store, you're going to find there are two types. There are do-it-yourself programs, and there are fully supported programs. The do-it-yourself programs are going to come with a lower cost. They're going to require you to do most of your own implementation. You'll be following, training materials that'll be provided online, so forth and so on. The upscale programs will be much more costly. They will come with an implementation, and it will get you there quicker, be more robust, but you'll be paying more than a nominal monthly rental fee that you would get for these do-it-yourself programs. So you have to first decide which path do you want to go by. And maybe you don't know. So what you have to do is you have to look at both types. Don't just look at the cost. Look at what the differences are. Ask the right questions. Try to get a handle on what it's going to take to implement if you're going to do that lower cost option yourself. And then you'll be in a better position to compare it to the more higher priced applications that will, provide the installation, the setup, as well as the one-on-one training.
Good. Another question, another two-part question. Could you elaborate more on cost of goods sold for service companies? Should associated salaries be moved from expenses to cost of goods sold?
Great question, and that's where I find the most often overlooked items is in a service business. We happen to be in a service business, right? We're people providing a service. And so when we track our time, we are charging to our cost of services. That's not a cost of goods sold because that's where there's something tangible involved. Cost of services is typically something intangible, like a person or a professional or something. So we track our time and charge the labor related to delivering our services to cost of services, that up above and right after the revenue, and then our overhead related time, our paid time off, our training, those sorts of administration time, that gets segregated and classified as a G&A expense. It is so important to do proper time tracking if you're in a service business. You've got to be able to, a service business in which you bill for time, I should say, or track for time. You've got to be able to separate out the labor costs that are involved in delivering the service from the labor costs that are involved in running a business, paying people for vacation or holidays or administration or training and all of those things. If you lump it all into cost of services, it's going to dilute your gross profit. It's going to give you a weakened number. It's not a realistic number. And the problem is that you're really cheating yourself because you're charging all of your labor up there when really only a portion of it is. And it's what's important. The reason why it's important to split it is not only from a gross profit percentage, but also from an administrative position. How efficient are we in the work? How much of our time is for billable services? There's no right or wrong here, but you would want to know, am I spending 5% for G&A salaries of my core people who are delivering the service, or am I spending 40% of their salary is in overhead? I mean, that becomes fairly expensive if 40% of someone's salary who's supposed to be delivering services is spent just, in overhead. Typically your delivery people, your delivery teams, they should be upwards of 80% of their time should be related to the delivery of service, and 20% should be down below. So those are some of the benefits to tracking time and figuring out, which bucket does it belong in.
Sure. Hey, Dennis, we're going to start wrapping up, but we didn't get to some of the great questions that people have been asking. Can I email you at that email address at the bottom of the slide right there?
They sure can. Yep.
Well, great. We want to thank you again for making this so understandable and so practical for all of us. We really appreciate it. And
my pleasure. Thank you very much.
Thank you, Dennis. We want to tell you about next week's webinar. Now, just because it's Friday the 13th, don't let that scare you. The topic is the right people in the right seats, and Jason Williford will discuss how to rev up your employee performance by correctly placing the right people in the right jobs. That's next Friday, November 13th at the usual time. Register at vistage.com/webinars. For all of us at Vistage, thanks for joining in today, and have a great weekend.